Welcome to the Great Capital webinar YouTube Live on rent growth and multifamily performance in 2023. I'd like to welcome everyone. Hope you're having a good afternoon. I'm joined by Director of Communications and Marketing here at Great Capital, Dr. Matt Bastnagel.
Hello.
How you doing, Matt?
It's good to be in the webinar. I think this is the first one that I was able to kind of contribute.
I think you're right. A lot of subscribers to the Great Capital YouTube channel are going to be used to this format because they probably have watched the Gray Report quite a few times. But usually, a lot of times, I do the YouTube lives and webinars solo. But you've been leading up our research efforts here at Great Capital and have produced some really two incredible reports this summer. The first one, which was released back in June, I believe, on upcoming loan maturities and potential distress in the multifamily market, was been picked up by sources across not only multifamily industry but also just kind of business in general. It's gotten a lot of attention for doing some analysis that had been really missing, of really getting more granular and starting to pinpoint some of the potential inflection points and times and just taking a different perspective, which is why I think everyone has been really looking forward to the release of the rent growth and performance report that came out last week. Just before we get into the details on this report, I guess first let's point to everyone to where they can go and download the report itself.
Yeah, for sure.
Matt. So what's that? GreatCapitalLLC.com
/rent dash report /and dash, but GreatCapitalLLC.com /rent dash report, and you'll be able to fill out a form and download that.
That's awesome. Appreciate it. Well, let's just jump right into the presentation. Again, Matt, this last year has been incredible. Really, the last 18 months. We've seen incredible rent growth in 2021. 2022, the first half was pretty solid, but since then we saw declines at the second half of 22, and then the first half of 23 was really very weak.
Yeah.
But you read a couple different sources, and you end up seeing sometimes a couple of different conclusions, different metrics, and especially when we're looking at market rent growth and maybe the CPI that the Bureau of Labor Statistics is putting out. It's like we're looking at two completely different metrics. We're seeing growth in one metric and declines in the other metric, and so that is some of the questions that we I think wanted to answer in this report of what is the difference between all of these different outlets.
Yeah, I think that the major story that we, kind of as we've been tracking rents, is that there are not only the difference between how the consumer price index tracks rents, but there's also the difference between the several private sources of rent growth information. So it's not just, and you will find the clearest difference between the consumer price index and any of these private rent growth trackers. Yeah. And that's like the chief story, and that's kind of how I understood it. But then if you dig into it even further, among that category of private rent growth trackers are 8 or 9 different sources, maybe even more really, that regularly update and make publicly available their information on rent growth, and those sources are all different, and they all paint slightly different pictures of how strong or weak rent growth is. Yeah. And so it kind of behooves you to you don't have to follow them all assiduously, but at least keep that in context and know perhaps have a way to characterize each source, especially CPI versus private rent growth, but also among the private rent growth trackers.
And we just pulled up just the graph of a variety of these sources. And I think the point that you made was really worth repeating, is that the different sources are telling us different things. It's not that it's not that one is necessarily far superior to the other. I think in some cases maybe the quality is better, or sometimes just more transparent. But oftentimes we're just looking at the methodology is a little bit different. We're really looking, we're answering different questions. You know, for example, some rent growth trackers and outlets are looking at the price that is marketed online, the list price of the units, versus some are looking at actual transactions, what leases are actually being signed for. Now, and you could say, I guess a reaction is, well, that's the better data of I want to know I want to know what rents actually are being paid, like the reality. I think most of the times that would be correct, but I think knowing what is listed is also useful information. It may not, you're going to use it in a different way of what the consumer is seeing. Then it leads to the next question, but what are they actually signing leases for? And then that difference you can infer a whole other, piece of data.
It is true. And a lot of what, these sources will do will have a separate section where they'll define their terms, they'll define the kind of math that they use, and just a little bit of their model, but to a T, I think probably save the CPI, which probably makes all of their data really publicly available. None of them tell how many is in their sample size. They're not
a pretty basic piece of kind of
exactly. Well, because
statistics.
And this is because they're they're not writing academic papers. They're not going to be peer reviewed and published in a journal, and they don't have to be they probably have to be they cover themselves legally, but beyond that, it is.
Well, but some of it's marketing information,
some of it is marketing information, and the function I think for a lot of these reports are to create this identity that the company has good data, and to say, hey, now you can pay to
they're kind of lead magnets. Now I want to get away from inside baseball a little bit, Matt, but before we do, we'll stay inside. We looked at several different reports: Yardi Matrix, Zillow, Apartment List, Redfin, CoStar, Zumper, RealPage, Realtor.com, then CPI, and then you took an average and then the average excluding CPI. So again, we've talked about it on the Gray Report a lot, but why did you exclude CPI? CPI is the one that has the biggest difference. What's the difference between CPI and some of these others? Like, why would you exclude it?
Yeah. So when you were talking about how the difference between market and transaction data, well, the even bigger lag between the asking and the price that's paid is CPI measures the new leases prices and the price of current leases. So you renew your lease every year. If you're on month 11 of a 12-month lease, and there has been so much rent growth in the past, and you're going to get a huge bump. Well, that's not going to be reflected in the CPI. And there have been.
Isn't the metric owner's equivalent rent of the primary residence?
That I think that is a different one if you're talking about all rents or something like that. But there also is owner's equivalent for that. But in the Fed themselves have acknowledged or at least one of the Feds.
I remember that white paper.
Yeah, had a white paper out that talked about how much. It's roughly a 12 to 13 month lag that the CPI lags private rent growth, and you can see that the hill is cresting for CPI rents about a year later.
Yeah, I mean that's a big lag. I mean, especially right now as rents started to decline again. Really, I mean December of 2021, it's really when they got off their peak, but certainly through the second half of 22 is pretty rough. But if you looked at CPI, you saw rents were actually rising, and the idea that the Federal Reserve is looking at CPI, not that they are unaware of other sources, but they're looking at CPI. That's feeding into the inflation figure, and also the rest of the economy is looking at CPI as its inflation growth, but it's relatively delayed.
If you're looking for signals. Then I would go with the private rent growth tracker, because that's a little bit more forward looking. If you're looking for the specific impact of rents on people's pocketbooks at a given time, then that's what the CPI represents. It's just the rents aren't paid every single day like many other commodities.
Yeah, no,
They're negotiated every year.
That makes a lot of sense. And then, and just again, that average rent, at least to date, year over year in the United States, 1.74%. Most projections, Matt, were around 3%, like almost across the board.
Yep.
For rent growth this year. Seasonally, we know if this year, which we, I think, as we'll see, it's starting to feel a little bit more normal, maybe a little more subdued, but things start to slow down around this year. It's not uncommon to see some negative rent growth in maybe November and December, as it's a slow time of year, and you're happy to get a lease and fill up a unit. I don't see us getting to 3%.
I will predict right now, and this is a little bit more of a gray report mode, that we will see some reporting and coverage of rent declines, and they will start saying, "Oh, we should start." I can't believe how much the apartment market is crashing, but I think that that's just normal seasonality. And we will see lower month-over-month growth. We have been moderating during a time of typical higher growth, but seasonality was helping us in the summer, whereas now I think that actually the moderation itself is weaker, and you can see that on this graph too, the way that things are sinking down. But the normal seasonality is what's going to affect us, not in any way I think a larger decline, even if we're just looking at the pattern of rent growth over the past year.
So we've been looking at year over year, month over month. What difference do the month over month numbers provide us versus that year over year? I mean, the base effects of looking at year over year numbers are pretty, can be pretty stark right now. So I'd imagine there's a difference.
Exactly. Like you can't see the smaller trends. Like if something is trending up over the past 3 or 4 months and going, oh, it's stronger, stronger, and stronger. Yeah. If last year was huge high rent growth anyways, that's just not going to be reflected in there. It washes, the data washes out. So, but if you look at it over month to month, and you can see, it may say there are times when year-over-year rent growth is decreasing, much like right now, where year-over-year rent growth is decreasing, but month-over-month rent growth is increasing. Now, this data only goes to June, and if we included July data, I think that we would finally see a probably stable or decreasing month over month.
But and I think we've got some slightly even more higher frequency or more recent data that we can get to here in a second.
Okay. But you can see from at the same time that a lot of these mainstream publications were saying, "Oh my gosh, rent growth is going down so hard." Ever since the beginning of this year. Actually, month over month rent growth has been trending upwards. So that's just it is important to look at, okay, what's short term, what's and if you're going to predict the future, which is what you'll be able to do it by the end of this webinar, then you want to look at month over month and every year.
So, and this is just another example. Or Matt, you've been making this point repeatedly on the Great Report recently, but trying to kind of be aware of where we are in like the larger cycle of things. And you've pointed to the fact that we're currently in the wake of, a big wave that was all the rent growth that took place post-pandemic in 2021, halfway through 2022. This long-standing, this chart goes back to 1975. And so, I mean, there's nothing even that's close to represent what happened in the market 2 years ago. If you look on this other chart, that this is from just 2013. It also includes a 5-year forecast, or 5-year forecast going forward. But the big point here is this, massive impact of rent growth. On this big spike that we would expect, and we were talking about this last week, and we would expect some declines, and it's actually surprising that we're still seeing some growth on top of this monumental growth that happened a year and a half ago. You would think that there'd be some more retraction, there'd be more correction, just given the math, like the simple fact that typically things revert to the mean.
And that's what I was, and you were very generous. You're kind of helping me work through this earlier this week when we were discussing, if you were just looking at the technicals, if you're doing like a technical analysis of the rent growth trend line, you'd get pretty scared. You'd think that things are going to revert to the mean.
What goes up must come down. And while the growth has come down, the actual nominal rate really hasn't gone down. So, these bars are the growth on this chart, but then, the line itself is the rent. And so, it kind of dipped down. It dipped down this pop back up. But you see, I mean, that dip, the spike up, and then the kind of the flat and to the right. That's the seasonal pattern before it lifts back up from the spring and the summer. And CoStar, at least according to this chart, and their base case, is predicting, who knows what's going to happen in the next couple of years. Yeah. But without knowing anything and special, they're predicting continued rent growth,
which is startling. Again, if you were just to think like, okay, this is what I keep repeating is we are in the wake of the largest change in rent growth in recorded history.
Yeah.
Whether it's crashing down or going up, which in this case it went up.
We had basically a decade's worth of growth within a year. Sometimes I think about it in the terms of like time being compressed or like dilated.
Yeah.
And now it feels like things have slowed down. But we're still growing. We still are. I mean, less than 2% isn't great growth, but you would think that in this economy, and there's a lot of surprises in today's economy, but you think there would be a little bit of a correction, especially with all the supply that's coming online.
The fact that we aren't correcting even more, considering we just had this, unprecedented rise. The fact that we're not corrected more, I think, is a sign of continued strength of housing demand, and it's not necessarily hurtling towards what we're seeing is typical seasonal effects. There is much more of a foundation, and this is another thing too. If we're talking about forward looking, a lot of the reporting, none of the reports or the sources are worried about housing demand, about apartment demand, even as they report.
There has been plenty to worry about from a standpoint of interest rates are moving up. Well, there's economic uncertainty, but then we've been all surprised. Just exactly your point. There's been a shock of how resilient the housing market has been, whether it's for sale or for rent. Especially, there's been a ton of supply coming on, single family and multifamily. A crazy amount of supply. Interest rates are just through the roof.
Yeah.
And while we still have some issues that the market's going to have to deal with in the next couple months, which we can talk about a little bit later on low maturities report, but from the fundamentals of supply and demand, taking kind of the financing out of it for the time being, surprisingly strong. And you could say the same thing about the U.S. economy and the U.S. consumer right now, which I think all of which is very much related. Matt, here's this chart. It's a little bit higher frequency, daily asking rent per square foot. Now, this is like up to I took it this morning from CoStar. You can see that, we had that, trip down from, the end of 22, really to bottom out in December, which, again, that's classic seasonality. It just the seasonal trends can be, amplified if there's other factors going on. But still bottomed out and then did a nice climb, really got out of 20, really kind of got out of there, there was still weakness in this period. We did see vacancy increase during the same period, but rents have been moving. But a little bit sooner than we typically see, we've started to see the decline come back. Yeah. From the peak, which looked like, rent growth has peaked in 2023, took place sometime early July.
Yeah, that is really interesting because a lot of the information from the rent growth report, you're starting to see that plateau in July, and if you look at it a little bit more granularly, there is, especially with the supply side, there is still some room and some softness in the apartment market, and that's a little bit of a worrying sign. But I think that the fact that it's coinciding with typical seasonality, it's more. Yeah,
I think it's going to be a weak year. It's going to be like a somewhat normal week on average year, but in context of, again, the previous couple of years.
Yeah.
To come out with any sort of positive growth is a big win. And obviously it's different regionally, and we're just talking national numbers, which, are only so useful in an individual decision, but it can be indicative of general trends.
So perhaps then, and you can correct me if I'm wrong, but I remember, typical seasonality, you don't see a whole lot of rent growth in the winter months of January, February. Maybe you see a little bit in March, but really it's like April on, until it peaks around July, August. And then what we're seeing now when we're looking at the daily asking rent is a continued increase even during the early months as there was this initial correction from the steep declines of 2022. There was initial correction, and then things slowly but surely we were reminded that we're still moderating from a 2-year rent growth that was sky high.
It's not a huge moderation. We've gone from 186 up to 188 per foot, and now we're 187 and change. So it's relatively small, but in terms of direction and momentum, it certainly is important. Also related, Matt, is the vacancy rate. Vacancy has been increasing. Again, a ton of supply is coming online across the country, especially in the Sun Belt. Sun Belt, we're seeing probably the most weakness outside of your San Francisco's. But from just a national perspective, the good news here is that as vacancy has increased over the first half of this year, it has really kind of flatlined for the last month or so. We're basically kind of moving sideways to the right. Vacancy is not still increasing, but I think we're it's too early to tell. There's a little, you can see, you were asking me about it earlier, Matt. There's a little blip up here at the end of this, where you're always wondering okay, is this an artifact of the data or?
It's the end of the month. Is there something about the end of the month? Because you can see,
you've seen Super Troopers when he's doing the target practice. And what about that guy? Don't worry about that. Don't worry about that.
guy. Well, and that's the thing too. And I wanted to note that too when we were looking at the change in the daily asking rent. My thesis is that things could have been a whole lot worse because we were moderating so much from a historic rent growth. But you have to keep your eyes open to the reality that we are in this moderating period, and we should kind of act accordingly. Don't expect the recovery to happen instantaneously. It will happen into 2024 more than any time in 2023.
We could have there's some really smart folks. CEO or president of Blackstone just, I think, put a blog post out the other day. Just the whole idea of things are going to be okay, but just really stagnant, slow growth over the next couple of years. I think that's going to, potentially including rents. Although if we see higher inflation, which they weren't exactly calling for, we should see higher rents. But we had so much growth. Again, we had over a decade's worth of growth crushed into a year. So now, there's expansion or refraction. Now all of a sudden we're going to maybe have a half of years worth of growth in a year as a nation. But, net still really strong if you look over a 5-year period. The problem is a lot of people were factoring that continued rent growth, and they paid for it in terms of a lower cap rate because they thought they were going to continue to get that growth. But they paid for something that may not actually come to fruition for some buyers, unfortunately. Look, Matt, I thought this was interesting. Vacancy by bedroom, because we talk a lot about work from home and the different preferences of renters, and they're prior to the pandemic, three bedrooms were out. Everyone was building this, the smaller the better, studios and ones, and then 2 bedrooms have always obviously been popular. COVID happened, pandemic, need more space. Also, millennials having kids. We need 3 bedrooms all of a sudden shot up in popularity. It's interesting. Their forecast, and it's really, tightened that the vacancy of the 3 bedrooms historically has been higher than other units. So you can see why. They're like, no, let's build more, let's build more studios, let's build more 1 bedrooms. Because you can see they usually were in more demand. But then, during the pandemic, all of a sudden you see this really a lot of the bedroom numbers really kind of close up because everything was in demand. Everyone was filling up, but especially the 3 bedrooms became more in demand than 1 bedrooms. At one point during 2021, all of these developers said, hey, let's go build a bunch of apartments with 3 bedrooms, which is probably still needed because millennials are having families and people need more space. We've seen some reversion, again, back to normalcy of the 3 bedrooms having a higher vacancy than the rest of the floor plan styles. And then CoStar is then forecasting, again, it's just a forecast. They don't really know, but they're forecasting there'd be a pretty wide gap, which that gap has already emerged in many cases, but it's to remain over the next year or so.
Yeah, I'm always curious of what their base of some of the forecasts are, and it's hard to imagine the gap not closing somewhat as we get used to. But what this gap could really be a response to is a massive shift in people's demand, because that gap doesn't happen unless we don't have our room layouts right. If it was closer, then everything, okay, we got the right 3 bedrooms, we got the this amount, but because of work from home and the different desire for more space, where suddenly an office, having that extra space is new. That's not built into maybe a lot of business plans or buildings themselves.
Exactly.
That's interesting.
The other takeaway is the sort of the volatility in the studio. Vacancy.
I'm trying to map the changing vacancy rates of these different 1, 2 in studio. Is this when people realize, okay, not everyone needs an office, and then studio gets a little bit more popular. And it's interesting to see how that compares.
Yeah. Vacancy marking asking rent per unit. Again, this is kind of combining just rent and vacancy. Again, it's showing that, vacancy expected to kind of increase but then fall off by 2025, but rent growth, moderate growth, but, forecasting growth over the next several years.
Yeah, I'm interested to, it's a little confusing how vacancy can go up so much without impacting their rent growth projection, and how that mechanism. And I know that it's not a perfect correlation.
You don't know that it's not.
Yeah.
You'd assume that rent growth would be higher if you had less vacancy.
Yeah.
I think it's just going to your point of how much demand there is in the market, in the face of all of the supply that is coming online. And then just looking at supply, absorption, net deliveries, and then also relative to vacancy. I think this may answer some of your questions, Matt. We saw, again, going back to after the pandemic in 2021, incredible amount of absorption, new leases being signed. And again, this is that period of just over exuberance, and everyone was just drunk on optimism that this was just going to always be like this, even though it was an aberration, in time. And I think most people deep down really knew that, but still a lot of money was put to work.
They thought that this would be forever.
It would just be forever, which, it's just wild to think of. But net deliveries, we have been delivering. We had negative absorption, though, kind of at the end of 22. Absorption has come back, but deliveries are still outpacing absorption, where that hadn't been really the case in not every year prior. We've had many years where absorption had really outpaced deliveries, which had, continued kind of the housing crisis and just the lack of housing in the United States. And while CoStar is forecasting, by 25 for us to be much more in equilibrium. Until that point, we're going to have a deficiency in terms of absorption and net deliveries
and
themselves.
It looks like it tracks through kind of the end of 2023 is where, just as the gap tightens between deliveries and absorption is when maybe net rent growth will start to kind of normalize and follow a little bit less of like a reacting to the past.
Yeah. One of the biggest, indicators of rent growth and major positive trend for multifamily is job growth. Matt, how did we look at job growth, in this report, in terms as a sign and a metric to possibly be able to forecast multifamily performance and rent growth?
Yeah, I think that it's one of these like fundamental drivers. It's one of the many factors that determine it, and I think if you're an apartment investor, you can look at this on a very granular level on how a neighborhood is doing and what kind of shops are in there. There's a lot of different drivers. I think one of them is what kind of jobs people have, how much money they're making. But I think one of the things that we highlighted here, just as a way to show how well the economy is doing, how well people's individual lives are doing, is the labor force participation rate and the unemployment rate as just signals of broader economic conditions. And unemployment rate is currently quite low, and the labor force participation rate, especially between 25 and 54, which is this kind of peak employment years and much indicative, I think, of a population of renters, that is among the highest it's ever been.
It makes sense. I mean, the big issue with the participation rate going down is all the baby boomers have been retiring and then filling those positions in the gaps, therefore. But a lot of those, millennials, Gen X and folks that are stepping into those roles should see their incomes going up as they're taking on more responsibilities and just working their way into the workforce and up through the workforce.
Yeah, and this report covered rent growth, but it is worth noting, that when the economy does better, rent growth is probably going to do better. Yeah. And in a recession, one of the things that goes down is probably rents. If the recession's deep enough.
I always said it's like multifamily. People. Is a recession resilient? Yes, like nothing's recession resistant. Yeah. And recessions aren't good for just about anything.
No one's going to have a great time there. Yeah. Yeah. But I think that one of the big trends that happened in the first half of 2023 is that people's economic projections slowly and steadily improved. And now, there's recent news, which is taking the Fed's minutes from their last meeting, that they had revised their own recession prediction. Yeah. And so they're kind of either delaying what was once a certainty in June, is now a possibility in in December or January. So these are getting pushed further and further away. 2023 is not. It may not end up to be a year with a recession. And that's going to be good for rent growth, and it's going to be more renters have more money, and there's higher demand for housing, and this gets into things like household formation, which we did not track in the report, but that's a really important. If you're forming a new house, if you're taking and splitting up your roommates, that is two rents, that's two rooms that are filled rather than one.
Yeah, yeah.
And so that kind of thing is happened, and that's all kind of driven a whole lot by economic growth. Rather than population growth is a big driver as well, and there's of course like a number of different factors. Yeah. But economic growth.
But employment growth is the closest thing you can tie to. A new job is created. Someone gets that job. They're making more money. They can pay more for rent, or they're going to go They're going to go out and move out and rent a unit that's going to add to absorption. Yeah. Yeah. Newly signed. That's awesome. What's shocking is unemployment and all these metrics, the economy have again been doing so strong relative to interest rates at the rate where they are being so high. Typically, when interest rates are so high, businesses invest less, the economy slows down, and layoffs pursue. But whether it's just the consumers are still demanding, so we still need the employees, but also it's like. All these businesses, all they've been trying to do is find employees, and they don't want to let people go because they're like, if we want to stay in business, we need the people to do the thing. Yeah, we can't get away from that. So we just need the bare minimum number of people, and they're not over hiring. Well, maybe some have overhired, and we have seen some layoffs relative to COVID. But you're very hesitant to lay off a bunch of people when you're not sure if you're going to use them or not. And that's kind of the underlying message of this report is we are living in the beginning, I think, of a new cycle, whether if it's in rent growth or economic growth, and especially when it comes to interest rates, we are in this new environment, and we may be here for a longer period of time. Yeah. Things may not get back to normal in an appreciably long amount of time. Yeah. And I think it's worth. What is normal?
So what that? Yeah, exactly. Well, it means that
we're 0% interest rates.
It means that the playbook 5 years ago doesn't work this year.
It doesn't work this year.
Yeah. But it also means that that it's worth paying attention to some of these metrics like rent growth and worth tracking things on a month by month basis and figuring out, okay, what is how does this source that I'm getting this information compare with other sources? So we're in the period of time, fortunately for a details driven nerd like me, to dig into the details. I think it will really help let you stand out from the pack and make good
Well,
decisions.
and if you don't have the time to dig into all the reports and details yourself, I mean, that's why we've got the newsletter we put out every Thursday.
We'll
You can sign up at greatcapitalllc.com/newsletter. But we're subscribed to the YouTube channel, the Great Capital YouTube channel, because we're breaking this down in the Great Report every Thursday, man.
That's right.
So let's move on. So this is the next page for the rent report. And again, everyone, if you're interested in downloading the report that Matt authored just last week, it was published, you can go over to greatcapitalllc.com/rent-report. And that is going to, you're going to be able to download that report and get all of this. And you can reach out to us if you have any questions. Matt would love someone to reach out to him and ask him all about this stuff. So looking at some markets, looking at some different metrics, not only rent growth, but rent relative to incomes, which I think is really, really important. Talking about affordability. And then also new supply, new apartments being built relative to the existing inventory. What's already there? Matt, we've heard that there's been some regional variations. You mentioned at the top of this report. Maybe first, before we get into the specific markets, what are some of the regional variations and divergence that we have seen so far this year?
Yeah, I think that this year has been, and I'm not the only one that has noted this year has been a year where increases in supply have made a big impact on really a select few markets, actually. A lot of the popular markets in the Sun Belt and sometimes some in the West, but a lot of these popular markets had got just a ridiculous amount of new supply, and that has naturally made rent growth a little bit slower in those areas.
Yeah.
And there has been market overperformance in places like the Midwest and the Northeast, which have a lot lower proportion of newly built units in proportion to their current inventory.
So just a lot of new supply coming online in the Sun Belt, not as much in the Midwest, and then the Northeast also is doing pretty well.
Yeah, and some of this now, each market has its own story. For instance, Miami gets a lot of new supply, does have a high cost of living, which is another factor that we note here, and also has just extremely high rent growth as well. But that being said, there are places like New York, for instance, it is also had such sluggish growth throughout the pandemic, and now it's kind of catching up. But a place like Boston, which their new supply 2.7, not a big number, and their rent growth 3.5, that's pretty healthy in the current environment.
Yeah.
On the other hand, the counterexample is a place like Phoenix, or let's pick out Salt Lake City, which had their new supply is 6.53. 6.53 of current inventory, and their rent growth is negative 1.4. And so that's just one general correlation. And like I kind of alluded to earlier, the other one is we tried to get a relative gauge of the affordability of each of these markets, because I think that if a market is more affordable, then there is a little bit more room for rent growth.
Yeah.
And what we did was compare the amount of rent based on, or we compared that as a percentage of the average household income. Now, that average household income does include homeowners.
Average or median?
I think I did median. Yeah, I'm sorry, median household income.
Yeah.
So among these people, and they include homeowners, you still get a good idea of the relative affordability of these different markets. So, for instance, Miami, again, this outlier, but
yeah, I mean, Miami, 40% rent to income ratio.
Yeah, that's super high, and it can partly explain why the rent
New
growth
York is 44, so it's not that the highest, but it is quite high.
And
where 30 is considered, anything above 30% is considered rent burdened and unaffordable, relatively.
And so these all have different character, but I do wonder if the rent income and the affordability acts like a little bit of a ceiling to how much growth can happen, but so then again,
Miami keeps growing, but there's a lot of markets here that look really healthy, and I think that there's some of the short-term impacts again of some of the supply coming online, but also I think some of the a lot of these Midwestern markets, they're known as being very resilient, and they're kind of just continuing to like earn their stripes of just being kind of steady eddies. They're always growing. They don't see kind of huge swings, but just like kind of keep chugging along. And it's sometimes like, the tortoise is winning the race.
So like it's kind of stereotypical broad brush narrative of what has happened is the markets in popular great places to live, places like Phoenix, and like, hey, everyone's moving there, places like Tampa, Atlanta, and Austin. It was a huge example. All of these like cool vibey cities. All of these great places had huge rent growth, then huge supply. Now they're reacting to the huge supply, and a little bit. I think they're rubber band. It's a little bit of a rubber band effect in terms of rent growth as well.
Yeah.
But that did not happen as dramatically, nor will it happen as dramatically in more stable markets in the Midwest that just are not associated with that kind of volatility.
And they're still already they are already considerably more affordable relative to some of those other markets.
Yeah.
Not that the Sun Belt is so unaffordable compared to New York City, but the Midwest is really showing that it is even more affordable, and will likely remain that way just because there's not that much supply coming. Okay, Matt. So also just there's 1 million, a little over 1 million units under construction in the United States.
That's another thing I think it's worth noting about general construction trends now. As you can see in the full report, if you download it, each of these cities has a different amount of supply coming online, but nationally there are general trends that kind of hold true for both cities, and one of them I think is this interest rate environment, which means that maybe we're getting a lot of new apartments coming online, but by the later half of 2024 and on into 2025, we will not see as many new apartment buildings built. And that's because there are less projects starting now because interest rates are so high. And so there's like the cause of effect there, but that just didn't.
So we should see a drop off in deliveries kind of somewhere 2025-ish going forward, which if the market does go through a soft spot, especially in the Sun Belt, should see a recovery, by 2025. Maybe sooner, maybe a little bit later, but around that time period. So it's a relatively brief period that you're going to have to hold on to. Which again, it emphasizes some of the difference between different strategies and shorter term strategies where you're getting there kind of flipping. It may be it may be a very challenging environment to do that. Maybe you can start next year, on a 3-year business plan, but you have to kind of take a long-term approach.
Well, because right now we are in that situation. Not only are there's this rubber band effect of the high rent growth, but we are also seeing all the apartments that were started to be built when rent growth was super high. All these projects got started, and now we're also seeing the supply come online too. So things are hitting at a lot of the same time. And the fact that we still have stable apartment rent growth at the same time right now is a really good sign for the fundamentals, and that's I think really driving why people's continued interest in the industry.
I think that's it. I mean, it's the fundamentals. It's different between the office market and the multifamily market. There's so much to like on the fundamentals. And we've got some other slides that I don't know if we even need to get into them. I guess if there's any questions or comments later at the end that we can we can get into. But if you're interested in downloading the report, if you haven't done so already, hop on over to graycapitalllc.com/rent-report. Download it, see what you think. We've in this webinar we've had some extra data that's not on the report, but you can really kind of zoom in and get much of what we've talked about today in the official report itself.
And we will be updating the rent report as new data comes in. And I think that it is important that we do have all this data on rent growth from all these different sources, and we want to stand out as an organization that provides you data from all of them, that puts all of this in one place for you. And that was really the underlying motivation that sparked my interest in creating this report, is just to give all this data from all these companies, get in one place. And I hope that's appreciated.
I think it is appreciated, Matt. And if anyone, if we're always looking for input, for ideas for new reports. I know we are going to be doing an update to the last report, the loan maturities and potential distress in the multifamily industry. We're going to be doing an update to that because there was a pretty decent call or in the report of, some potential distress or kind of a wave front starting kind of late September or October, kind of through the first half of 2024. Maybe we can revisit just before we run. We can touch on a little bit, but in the report, which can be found at greatcapitalllc.com/report, October was a big month, Matt.
Yeah. And that actually, yes, we are updating it, but that has not changed. One thing,
the maturities are the maturities, right?
Yeah. And what is interesting is that much has not changed in terms of coverage. Now, people are starting to key in on the size and the potential of multifamily, but the timing of it, which was really part of what motivated our interest in publishing this loan maturity report, was to nail down the specific timing of this. That timing has not gone away, and it remains as dramatic as ever, and it remains as not really many people are commenting on it, and it's coming up in a couple of months.
Well,
a month and a half.
Part of it is, and so here's just a preview of the report. Again, greatcapitalllc.com/report for this, but just zooming in, there's two graphs that I think that tell most of the story. This first one, Matt, is the transaction volumes, quarterly transaction volumes. Going back into the fourth quarter of 2021, you see this huge rush of transactions. And again, because over exuberance, we saw the period of rent growth on the previous chart. Let me see if I can grab it real quick, or I'll go back to it in a minute. But huge amount of transactions. People were so bullish. People have never been so bullish. Locking in, they thought crazy low interest rates. Some of them were floating. And so it's not surprising that 2 years later, which many of those acquisitions, not all, but many, were financed through, relatively short-term bridge loan products that have 2-year terms. So what happens? 24 months, it's not hard math, 2 years later, so fourth quarter of 2023, which is where we are, barreling towards very soon. There's a big spike in loan maturities, and many of these properties may be underwater or may be distressed because the rates and the leverage that they acquired is not going to be sufficient to roll over to new debt without bringing a lot of money to the table to actually close. It's not shocking that we're not seeing the blood in the streets already. Look at the maturities for the several months prior. I mean, in July, there was a decent amount, actually, and we saw actually some rumblings of, some potential distress last month, but the maturities actually decline into one of the lowest levels. September is going to be like the quietest month of all time. Now, there may be some movement on preparations. It is, people are going to be out of options if they can't make something work with their lender, if they can't get an extension, if they can't modify the loan terms. We're going to go to 0 to 60 in under 2 seconds here, Matt, getting up to basically $4.5 billion. This is just CMBS. This isn't even like the bridge loan. This is just the kind of the regular loan CMBS. I think there was, what was the last graph? I think it was like 120.
If you're including information from all lenders, there's a lot more, a lot more outstanding debt in the multifamily space.
So this is 110, almost 120 billion.
Yeah, that was the sales for
sales.
Fourth quarter.
Exactly. And so there's a lot more, which we haven't been able to get the exact number. There's a lot more than just $8 billion in October and November. Yeah. I mean, it's going to be it can be many tens of billions that are all maturing.
And what also hurts is that not only are these operators dealing with the environment that changed in 2 years, yes, but they're also interest rates are high, and they're dealing with the still lingering effects of inflation, in which 2023 you're re-signing a lot of your vendor contracts, and they are they go up. I think you can kind of speak to that a little bit better than I can, but there are a lot of pressures. And I think that apartment operators are very well aware of the expenses and utilities that have gone up in 2023 at the very same time that interest rates have gone up. And that is very difficult to manage.
Yeah, it's Matt. I mean, over the last year and a half, and what's happened? I mean, cap rates have come up, which means prices have gone down. No question about that. Kind of, 7 caps are the new 5 caps. Or if you were in a 4 cap world, then you're at the minimum, you're in a 6 cap world now. So prices have come down. Expenses have come up. You're exactly right. Every vendor, re-looked at what they were charging, and they up their prices because their payroll's gone up, their costs in materials have gone up. So costs across the board have come up. We saw the rent growth metrics. I mean, there was some good, strong rent growth in 2021 at the beginning of 22. It's not going to save you. If you just bought that property at the end of 21, you had a couple months of good rent growth, maybe, and then it was flat. You certainly didn't get your 10, 20%. That already happened. So you've had maybe slightly positive rent growth, negative for some. Even if you had some decent rent growth, your NOI growth, your net operating income, which is your income minus expenses, flat or maybe up a little bit. It's not up enough to move your value. But then when you look at the equation that we use to derive value, typically in commercial real estate, you look at the cap rate, you take your net operating income, your NOI, which again, income minus expenses, divide it by the prevailing cap rate in the market, that equals your value. So, your 2 variables are your net operating income and the cap rate. If the net operating income is flat or hasn't changed, and the cap rate has gone up, then your value has gone down.
So if you're making $1 million a year and your cap rate's at 7%, then it's worth less than if it was a 5%.
Yes. So significantly. Okay. So what also has happened is their idea was they're going to refinance this property after 2 years, pull a lot of money out, or maybe sell it and make a lot of money. What also has changed is they can no longer get the size of the type of leverage with the same loan that they could have when they acquired it. So when they acquired the property, they acquired it using, maybe they got 75% loan to value, leverage up 75% of the purchase price or the value of the asset. Well, today maybe you can only do 65 or 70. So even if the value was the same, which maybe it'll appraise the same, because appraisers are like, let's get the deal done. Let's say it appraises the same, even though we all know the value is way less. You can't get the leverage because your interest rate is much higher that you're going to be paying. The lenders don't want to lend out at loan to values that are much higher because you're constrained by your debt service coverage ratio and your amount of cash flow. So like being generous, again, if your value is the same, even if the interest rate was the same, which it obviously isn't, but you can only get a 65% loan to value, you have to bring cash to the table. And if you've actually, if things have gone really poorly, if you really levered up and now your rents have declined, you're going to have to go back to your investors to raise more money to save the deal. Otherwise, there's a chance it goes back to the bank.
Even if it's the same interest rate, if the LTV goes up, then it's like, oh, no, we got a loan for 65% or we got a loan for 75%. And now we need, our loan just got smaller. So we're going to need to bring that extra 10%.
Yeah, you buy a $20 million property, your original loan is $16 million. Okay. Now you go back to the bank and they say, okay, we're only going to give you a $10 million loan. And say, well, I need 16 to pay back the first guy. All right, but we're only going to give you $10 million. And it's like, well, okay, I have to go raise $6 million.
So
I only had raised 4. So your returns in that scenario get cut in more than half. What investor wants to sign up for that? They have to decide, do I put more money into this with the idea that maybe I'll get my money back at some point a little bit, but I also could double up and lose it all. Or do I just write this investment off? And that's a tough question that many LPs are going to have to wrestle with. As an LP in other sponsors deals, I've had to wrestle with that on a couple different occasions. It's not easy. Sometimes it's do you believe in the sponsor? Do you really believe in the deal? Is it a blip? What is the dilution if you don't meet the capital call? Because if you don't meet the capital call, you'll get squeezed down. Your equity percentage will go down. Is it worth maintaining that equity percentage to chase good after bad if it's not going to lead to anything? I've seen it go a variety of different ways. We've never had to do a capital call, a great capital though. And, our last bridge loan we refinanced last week. We got cash out. We were able to crush the business plan, but that was, there's a little bit of luck just on timing. Literally, if we had rate locked a week later, if we didn't close last week, the 10-year Treasury has gone up 30 basis points in the last week. truly real time, Matt, post this report even being released on rent growth and performance. Last week, the 10-year treasury was at 3.9. I mean, it was at 3.7, a month and a half ago or so, maybe 2 months ago. The hope in the prayers for so many commercial real estate investors are that rates will come down and the rates will be lower, so they'll be able to refinance.
Yeah. That
has not happened. It's not happened on the short term rates, floating rates. It hasn't happened on the long term. Everything's peak rate interest rates right now. They're higher now than they have ever been.
Yep.
Like, they were declining a little bit. Everyone was excited. I remember at NMHC this last year, everyone's like, they're starting to come down. Then they spike back up. Came down and they've spiked back up.
So much depends on how long people think that this high rate environment is going to be. And another large trend, along with the rent growth trends that we just discussed, is that people are increasingly predicting higher for longer.
Yeah.
Rather than a recession that may trigger lower rates, rather than lower rates just coming down and somehow landing the plane.
We need a recession to flush everything out the system to actually do the reset. Without the reset, we're just going to keep, I guess, gliding along, on fumes. But then,
and it may go down slowly. It's not unprecedented that they have been this high. This is a different, but the upshot to the two red lines that we showed, that represent so many of these loan maturities coming due and so much potential distress. The reason for that is that people thought that it would come back to normal, and the rules are not applying in the same way.
Yeah.
I think that, there's ways to structure your things and plan for potential risks in general. But it does seem unusual. And because before the current rate hike regime, we were talking about how, interest rates historically since the beginning of time have been trending down. But, I get this is a little counterexample.
Well, and it's at the large. And what part of the trend? Is it? Is it part of a super cycle? Is it Is it a news cycle? Again, with the pandemic, putting so much chaos into the system, it truly is. I'd say impossible to say one way or the other with any degree of certainty. But that's why it's key to plan. When you build your business plan, you have to be somewhat aware of a variety of different outcomes. And that's why, again, it's not, you don't always get the highest return planning for a long-term hold, because especially if you're going to fix your interest rate. There's prepayment penalties. You're going to be typically tied into a longer-term hold. The longer you hold something, typically, the return goes down because your velocity of money isn't as high, but it also it reduces risk. I'd rather be certain of making a double over time rather than maybe getting a double and losing it over 2 years. Like over 5 years, okay, I'm very confident we can double, maybe triple, we can double it, and in 10 years we can triple it, versus taking a lot of risk and doubling it in 3 years, so I can quadruple it in 6 years. Which is clearly, if you can get a 4x in 6 versus a 3 in 10, you're making a lot more money. But there's also a possibility that if you take the more aggressive approach, you lose everything. Or it doesn't turn into a triple, that you just get your money back, and then you're years behind. I like the certainty, and that's just like how I learned about investing. It was not even though gambling and investing, you're making bets. You're always making bets. But the difference between the way some people get closer to gambling when they're investing, in terms of I'm kind of rolling the dice on this thing, and if it doesn't work out, it's fine, but if it does, it's going to hit big. And that's like that, and that's a strategy, but that's just when you're taking hard-earned money, and a lot of it, and you have an objective and a goal. I'm going to grow it to here. I want it to produce this much cash flow. I'm not looking for, a return profile that's all over the board and maybe it's going to work out, maybe it's not. I want certainty. And there's room for both for everybody in their life, but the way I view investments is
that's what distinguishes it from, is a level of certainty, period, versus gambling.
So if I know over a 10-year period, I'm much more confident that rents will be higher in 10 years than they are today. And also prices are going to be higher 10 years than they are today. Mm-hmm. Now, nothing's 100% certain, but just looking at past examples, there's very few that 10 years is insufficient to weather a storm. So I think having that perspective, having as much flexibility and options, and if you can turn around and sell something early, that's great.
Yep.
But maximizing the chance of success has done well for us, and we set up a lot of our investments. You mentioned, we don't have a lot of floating rate stuff. We're mostly fixed. It's all long term. Yep. Here, brokers call us and, are you guys doing all right? I'm like, we're doing fine. Mm-hmm. We're good. We're frustrated because we can't buy deals. Yeah. But we're not worried about our current deals because they're all set up the right way. Mm-hmm. They're not on autopilot. I mean, there's a lot of active asset management, but all is good. We're not like I'm not like unable to sleep because we've got loan maturities coming.
And that's, I think, maybe what's driving the greater confidence in the multifamily market in general is that the fundamentals are still pretty strong, and there is the stability of it, even despite perhaps rent growth could have been better. But I think a lot of people are able to take it in context that we've had so much rent growth in the past couple of years, and we're at this place where we're actually pretty good, all things considered. Yeah. But you have to consider all the things, and you have to know where you are on this timeline. And without knowing the near-term things that are important and the long-term things that are important, you can either get laser focused and try and say, oh, rent growths are rising forever, or you look at now and say, oh, rent growths are falling forever. So we get stuck way too much in like the media, what's ever happening right now, which often is what the media is saying that's happening right now, which actually happened 6 months ago, which actually may be a even more lagging metric. As much as we kind of wag our tongues or wag our fingers at the media for reporting things, there are solid billion-dollar investments that are made in which people make the same kinds of mistakes. True. And I think that some of those are going to bubble up. The consequences of those are going to bubble up in the next few months. Yeah. Well, I agree, man. I think the next several months, really through the first quarter of 2024, are going to be very telling. Probably, if all is clear, we're in Q2 of 24, then, I think that... I don't know, off to the races, and we're just going to be stuck in this environment. But if you have any questions for Matt or myself, please let us know in the chat. We appreciate everybody watching this YouTube live. Again, you can download the rent report, greatcapitalllc.com/rent-report. Go to greatcapitalllc.com. I mean, there's a link right there to it as well on the homepage. That may even be easier. I put a link in the good old chat. So yeah, just if you're interested in asking a question, then if not, we will sign off. But man, Matt, this has been a lot of fun. Yeah, thanks. This has been good. We'll continue to update it, and you can look forward to a lot more of these webinars and reports as we continue, because I'm just getting started here. I know. It's so far, Matt, they've been received really well. And again, the loan maturity report was, really widely distributed. Mm-hmm. The rent report is starting to eke out there. Just was released last week, right before the CPI report was put out there on Wednesday by BLS. And I think the follow up to the loan maturities report is going to be very timely. And I know I'm waiting on the edge of my seat. Oh, good. So, yeah. Well, we'll stay on top of things for sure. Yeah. Well, if no more comments, again, we appreciate everyone taking the time watching this live. It's going to be reposted, so you can re-watch it, watch it a couple times, bring the kids around the phone or the tablet, for some Saturday morning viewing, or just when you're at the restaurant, be like, kids, I need you to eat the cheeseburgers. Just like watch this webinar, watch this YouTube live. I like it for the multifamily industry. They're gonna be like, this is great. Yeah, that's a good point. Like those E-Trade babies, or what was it? Oh yeah, I forgot about those. Yeah, we got to get our own babies.
We've got enough. We got some babies. We've got some babies.
Yeah, that's true.
We've got some babies. We can conscript. All right. We are going to end the stream. Thanks again. There'll be a replay. Share it. Make sure you subscribe to the Great Capital YouTube channel, because not only do we do these types of YouTube lives, get into these reports every week, we're breaking down all of the latest research reports and data on the multifamily industry, real estate, commercial real estate, and the economy. And if you are an accredited investor, hop on over to greatcapitalllc.com, sign up for our investment portal. Just, dig around in there, see what you can find. A lot of new opportunities.
Yep.
We don't have any live deals right now, but make sure you're signed up so when we do have a live deal, you can make a commitment for it and you can be on the list, because we've got a lot of interest for our next deal, Matt. The last report that we put out and we asked people if they were interested, I think it's been downloaded over 1,000 times. And I think we've got like over 500 people who are like, I want to be on the Great Capital's next deal.
Oh, great.
See how many of them actually participate, but a lot of interest. So if you want to get on the list, again, if you have to be an accredited investor, because the SEC, they want you to, they want to protect you from yourself. They don't want you to spend your money in a way that they think might harm you or could help you. So you have to be accredited, unfortunately, but if you are accredited, we'd love to have a conversation with you, partner up. Produce some great cash flow, buy some great real estate, make better communities, and make better investments.
That's great.
Awesome. All right. Thanks for watching. See you later.